$66. That's where silver sits right now, December 17th, 2025. But here's what stopped me cold this morning. 45 years ago, the Hunt brothers pushed silver to $50 an ounce and it crashed. Hard, crashed 80%, wiped out fortunes, destroyed lives. The financial establishment learned their lesson. They built something massive to stop it from happening again. A paper silver market 50 times larger than the physical market itself. Designed to suppress prices. Designed to keep silver expensive to borrow, cheap to sell short, and impossible to squeeze. For 45 years, that system worked. But something changed. Something catastrophic. And right now, in December 2025, you're watching that entire suppression structure collapse in real time. I'm about to show you why this isn't the Hunt brothers bubble repeating, why this is actually worse, and why silver sitting at $66 might be the smallest number you'll see it at in the next decade. I'm not a financial advisor. This is not financial investment advice. But what I'm about to walk you through is pattern recognition from history, combined with numbers from the Silver Institute, COMEX filings, and central bank reports. And the patterns have never been wrong. So buckle up, because the story of silver's next 10 years is probably not what you think. Let's start with the most basic question. What in God's name happened to silver this year? January 1st, 2025, silver opened at $29.29 per ounce. Today it's $65.84. That's a 124.58% increase. In 11 months. 125%. The stock market averages about 10% a year. This metal just did a full decade worth of stock returns in a single calendar year. But here's the part that frightens the institutional investors. It didn't do it like a speculative bubble. It did it like a structural awakening. It marched upward all year long. October came, and silver broke $50. That was the first time in 45 years. First time. 45 years since the Hunt brothers tried to own all the silver in the world and got destroyed by the establishment's paper market. For decades, every analyst, every central banker, every major fund manager said it couldn't happen again. The system was too sophisticated. The paper market was too deep. The shorts were too powerful. And they were right. Until they weren't. Because something fundamental shifted in the market structure. And nobody saw it coming until it was too late. In 1980, the Hunt brothers held about 200 million ounces of physical silver at their peak. That was 1/3 of America's entire supply at the time. They leveraged themselves mercilessly, bought on margin, bought futures, got greedy, got reckless, and in March 1980, the establishment just changed the rules. Margin requirements jumped. No new long positions were allowed. Forced liquidation began. Silver Thursday, March 27th. It crashed from $50 down to $11. 80% drop. Fortunes evaporated, people's lives were destroyed, and the establishment learned the lesson they needed to learn. Never again. So they built the largest commodity paper market in history, a market where you could trade silver that doesn't exist, where promises outnumbered physical metal by 50 to 1. They called it derivatives, futures contracts, options, all of it designed to keep silver suppressed, expensive to squeeze, and mathematically impossible to corner. For 45 years, it worked. But by 2025, it had been too successful at the wrong time. Here's what happened. Solar energy exploded. 232 million ounces of silver were consumed by the solar industry in 2024 alone. That's a 4 times increase since 2015. Every solar panel made needs silver. Lots of it. They've been cutting the silver content down with new technology, but the volume of panels being installed grows so fast that efficiency gains don't matter. More solar panels means more silver. Period. And it's not just solar. Electric vehicles need silver for their battery systems. Semiconductors need silver for chip manufacturing. Data centers need silver for cooling systems. AI chip production is increasing silver demand faster than anyone predicted. Suddenly, industrial silver demand isn't declining. It's at record levels, 680 million ounces in 2024. Record high, and the market wasn't prepared for it. Because the market had been built on the assumption that silver demand would decline forever, that solar wouldn't work, that EVs would never scale, that semiconductors would find substitutes. None of that happened. Demand exploded just as something worse started happening to the supply side. For the past 5 years, silver has been in a structural deficit. Not a cyclical shortage, not a temporary imbalance, a structural deficit. That means more silver is consumed than mined every single year, 5 years running. In 2021, deficit was huge. In 2022, massive. In 2023, 184 million ounces short. In 2024, 148 million ounces short. And it's projected to be over 100 million ounces short again in 2025. That's a cumulative shortage of 700 million ounces in just 4 years. 700 million ounces of above-ground stockpile just vanished. Consumed. Gone. When you have structural deficits, You need supply to respond. You need miners to dig faster. You need production to expand. This is where the system breaks. 70 to 80% of silver production comes as a byproduct from copper mining, zinc mining, lead mining, gold mining. Silver mines are basically non-existent, which means when silver prices rise, copper miners don't accelerate their copper production. They optimize for copper. Silver is just what comes out the side. You want to build a brand new silver mine? Congratulations. You're looking at 15 to 18 years minimum from discovery to production. $500 to $600 million of capital. And by then, the financial picture could have changed a dozen times. So supply doesn't respond, it can't respond. Not quickly, not easily. And certainly not when we're trying to recover from a 700 million ounce deficit. Mining production out of the ground has actually declined. In 2016, miners produced 900 million ounces globally. In 2024, 819 million ounces. 8% decline despite silver prices rising significantly. This tells you everything you need to know about how inelastic silver supply truly is. Price signals don't work for silver the way they work for wheat or oil or copper. You can't just plant more wheat if the price is high. It takes a season. But you could theoretically expand oil production faster by drilling more wells in existing fields. Silver? You're waiting 15 to 18 years for new supply to even think about showing up. And the big producers are facing their own problems. Mexico produces 21% of the world's silver. They're facing permitting delays, labor disputes, regulatory uncertainty. Peru produces 12.5%. They've had massive labor strikes. Their ore grades are declining. Russia produces about 6 to 7% but can't export because of sanctions. Together, Mexico and Peru alone account for 34% of global production. 34%, and both are in crisis. If you wanted to design a system where supply can't respond and demand is accelerating, you couldn't do better. It's almost as if someone planned it that way. But here's where it gets weird. Here's where we move from fundamental commodity dynamics into financial market structure. Because just when structural deficits were screaming their urgency into the market, something extraordinary happened. JP Morgan flipped. In the early part of 2025, JP Morgan was short 200 million ounces of silver. They'd been short for a decade. They were the biggest bear on the market, the force keeping prices suppressed, the seller every time prices started to move up. And then, between June and October of 2025, they covered that entire position. They bought back all 200 million ounces of their short, and then they didn't stop buying. They accumulated. Today, JP Morgan is long 750 million ounces of physical silver. That's not a typo. 750 million ounces. Estimated $8 to $10 billion invested. That's more than the Hunt brothers ever held. That's nearly a full year of global mine production. That's 45 to 50% of the estimated above-ground deliverable silver supply sitting in JP Morgan vaults. Think about what that means. The greatest downward pressure on silver prices in the last decade just flipped to upward pressure. The bank that was selling silver every time it went up is now the largest accumulator. The bank is positioning for what they clearly believe is structural revaluation upward. You don't accumulate 750 million ounces of physical silver if you think prices are going down. You do it because you think they're going up. Significantly. And then, December came, and the physical market started screaming. From December 1st through December 4th, over 47 million ounces of silver were claimed for physical delivery out of the COMEX. That's 60% of COMEX's total registered inventory in 4 days. 4 days. People don't demand physical delivery of commodities they think are going to drop in price. They demand physical when they don't trust the paper. When they believe there might not be enough real metal to cover all the paper promises, 7,330 futures contracts were demanded in a single day. That's 36.65 million ounces, 30% of COMEX's free float inventory claimed in one trading day. And the inventory didn't recover. It drained further. Shanghai inventory dropped. Registered inventory stayed depleted. The message was crystal clear. The physical market was experiencing a genuine shortage. This wasn't a bubble, this was stress. When a market is in physical stress, futures prices start trading at a discount to spot prices. That's called backwardation. And backwardation is screaming higher prices. Because when people are willing to pay more for immediate delivery than for future delivery, it means they're desperate for physical metal right now. Lease rates on silver jumped to 40% annualized. 40%. Normal lease rates are 2 to 5%. 40% means institutions are literally borrowing physical silver at extreme cost just to get delivery right now. You don't do that in a normal market. You do that in a squeeze. And the physical retail premiums tell you the same story. American Silver Eagles, the most popular physical coins, were trading at $9 to $12 above spot price. In 2024, premiums were $3 to $4. They nearly tripled. Dealers were struggling to get supply. Customers were willing to pay premiums that should be physically impossible, but they were paying them because they understood something the financial media didn't want to say out loud. Silver was becoming physically scarce. Not theoretically scarce. Actually scarce. Real physical metal was hard to get. The paper market could pretend there was unlimited supply, but try to buy actual coins, actual bullion, and suddenly the pretense evaporated. So here we have the perfect storm. Structural supply deficits that can't be fixed for 10 to 15 years. Record industrial demand from solar, EVs, semiconductors, that's inelastic to price. JP Morgan's historic accumulation of 750 million ounces creating a supply shock. COMEX vault depletion signaling genuine physical stress. Physical retail markets showing premiums expanding, and the gold-to-silver ratio suggesting mean reversion upward. Let me explain that one. Historically, gold trades at about 65 to 70 times the price of silver. That's the historical range. Right now, gold is at $4,200 and silver is at 66. That's a ratio of about 69 times, which means silver is almost exactly at historical mean, maybe slightly undervalued. But here's the thing. The average over 450 years is actually 55 to 60 times. Silver historically is being suppressed relative to gold. If that ratio reverts to just 60 times, with gold at 4,200, silver would need to be $70. $70. We're already there. If it reverts to 55 times, silver needs to be $76. If it reverts to 50 times, silver needs to be $84. None of these are wild scenarios. They're just mean reversion. They're normal. And yet, if the ratio gets aggressive, if we see gold at $5,000 and silver at 50 times, you're at $100. If the ratio gets to 40 times, you're at $150. Now, let me be clear. These aren't predictions. These are mathematical outcomes if normal mean reversion processes occur. Mean reversion doesn't always happen. Markets don't always correct. But when they do, they typically overshoot. The question isn't whether mean reversion happens. The question is how far it goes. Compare this to 1980. In 1980, at the peak, the gold-to-silver ratio was 15 to 17 times. That was an extreme. Extreme. The Hunt brothers had driven silver into such overvaluation relative to gold that the ratio was half of what it normally is. That's what a true squeeze looks like. We're nowhere near that now. We're sitting at historical mean or slightly below, which suggests if structural factors push this higher, we've got room to run. That's the technical case for why silver at 66 might just be the beginning. But here's what the bears need to understand. Unlike 1980, this isn't being driven by speculative leverage on margin. Nobody's buying silver with 30 to 1 leverage. It's not happening. The leverage story is dead. JP Morgan isn't using borrowed money to buy 750 million ounces. They're not using margin. They're accumulating physical. Central banks are accumulating. Sovereign wealth funds are rotating into silver. The money flowing into the SLV ETF is real money from real investors who understand inflation hedging. The solar industry is buying silver because they need it, not because they think it's going up. This is structural, which means when this bull market corrects, it won't crash 80% like 1980. It'll correct 20 to 30% maybe, and then continue higher. Because the foundation is real, the deficits are real, the demand is real. Analysts are now calling for $80 by end of 2025. Some are calling for $100 by mid-2026. BAFA is saying 65 to 100. Conservative models show 85 to 100 by end of 2026. Bullish models are calling for 150 to 200 by 2028. Why? Because if you model out the deficits continuing, industrial demand accelerating, and the structural changes in the market taking time to adjust, silver needs to go higher, much higher, to bring supply and demand into balance. Right now, silver is rationing through price. The price needs to go high enough that some industrial users start to reduce consumption at the margins. The price needs to go high enough that recycling accelerates dramatically. The price needs to go high enough that exploration companies decide to actually build new silver mines. And all of that takes price appreciation, significant appreciation, because the structural forces are so strong that it's going to take a shock to rebalance the market. This is the bull case. And it's not built on speculation. It's built on math. Now the bear case exists. It's real. If we get a major recession in 2026, industrial silver demand could decline 5 to 10%. Investment demand would evaporate. We could see silver correct 20 to 30%. That's possible. But even in that scenario, the structural supply deficit is still there. The mining production problem is still there. The byproduct dependency is still there. You don't solve that with a recession. You just postpone the reckoning. So the bear case is a correction, not a crash. And the bounce off the correction could actually be more explosive than this initial move. Because that's when institutional money that's sold into the strength starts buying back the weakness. And because the structural case keeps getting stronger the longer the deficit persists. Which brings me to the thesis that I think is most likely. This is stage 1. Not of a months-long bull market. Stage 1 of a decade-long bull market. Here's why. The structural supply deficit will persist for the rest of this decade and into the next. New mines take 15 to 18 years to develop. No meaningful new supply arrives before 2032. which means deficits continue, cumulative shortages keep accelerating, and by 2035 or so, there will have been a 3 trillion ounce cumulative shortage since 2025. That shortage has to be addressed somehow, either through price appreciation so massive that demand destruction occurs, or through the exploration and development of new silver mines. Either way, silver needs to go much, much higher. The industrial demand for silver is structural because it's driven by government policy mandates for solar energy, EV adoption, semiconductor build-out. These aren't optional. These are requirements. The EU Green Deal requires solar. The US Inflation Reduction Act requires EVs. The global commitment to net zero requires massive solar expansion. No recession changes those policies in the short term. Industrial demand stays sticky. So we have accelerating demand meeting declining supply for 7 to 10 years. That's the recipe for a decade-long bull market. That's why JP Morgan is accumulating now. That's why central banks are starting to buy. That's why the physical market is showing such stress. They all see it coming. They're all positioning for what's coming. The question is, do you want to be positioned ahead of the move or waiting to buy after 60% of the gain has already happened? And here's the truly frightening part. We're only in stage 1. The most powerful moves in bull markets happen in stages 2 and 3. Stage 1 is the breakout, the breakthrough all-time highs, the physical stress showing up, the big money showing up. That's happening now. Stage 2 is when the story starts to go mainstream. When CNBC starts covering silver, when financial advisors start recommending it, when retail money starts flowing in because they've seen the price move and they don't want to miss out. That's probably 2026. Stage 3 is when supply actually fails, when a major dealer can't fulfill an order, when COMEX threatens to go cash settlement only instead of physical delivery. That's probably 2028 or 2029. When that happens, silver could move 4 or 5 times in a year. It happened to oil in 2008. It happened to uranium recently. When a market faces actual delivery stress, price moves accelerate to the parabolic level. And you're early. You're watching stage 1. You're watching the infrastructure of physical stress building. If you understand what's happening, you can position accordingly. And if you don't, you'll be chasing 25% moves later on and wondering why you weren't positioned earlier. Subscribe now if you want to follow along as this unfolds, because the next decade of silver is going to be one of the most important wealth transfer periods in recent market history. Those who understand the structural deficit will own assets that appreciate 500 to 1,000%. Those who don't will wonder what they missed. The choice is yours. But the mathematics doesn't lie. The structural deficit is real. The industrial demand is real. The physical stress is real. And silver at $66 is just the beginning.